In your private investment group, Thorney Investments Group, I understand that you invest in some digital currencies. I'm curious, do you have any plans to carry that over into either of your listed vehicles?
Well, in the technology company, again, we've been following the thematics. It's not so much that we've invested in the currencies, but we are a believer in blockchain technology, for example, which is, we think, going to be more and more a fundamental infrastructure of transactions. And so we're looking for really, if I go back to the early days of Thorney, just to digress for a moment, we did a lot in the resources sector, not so much in going directly into exploration companies, occasionally yes, but more so in what I call the picks and shovel approaches. So we invested in the mining services company, the engineers, the construction, the equipment suppliers, labor force supply, and so on. So to some extent, we've taken the same approach, because I don't know which currency is going to be a winner in the long term, really, and I don't want to be a speculator on behalf of other shareholders. So we've invested around the space in the picks and shovel equivalent. So in Thorney Technologies, we have an investment in an Australian-led company, but Canadian listed, called Banxa, which is a crypto exchange, if you like. And that's growing its transactional volumes quite successfully and dramatically off a small base. And that's been a good winner for Thorney Technology, and we still have that position. That listed, we were in the pre-IPO. It listed, I think, in January this year of around $1 Canadian, and it's trading, I think, at $3 or thereabout, having been as high as $6 or $7, I think. And so we think that's well positioned to take advantage of the growing awareness and the growing transactions that are happening in cryptocurrencies. In addition, for example, we've invested in some Bitcoin miners. Cosmos is one that's going to list in the NASDAQ shortly, and another one which we're very excited about and is a good sized position in tech is a company called Iris Energy, run by a couple of brothers, Australian guys, ex-Macquarie people, and they're growing their exahash capacity and computer capacity enormously. And I would add on a green basis, in other words, their power source, which is a critical component of Bitcoin mining, is from hydroelectricity primarily, and they're located primarily in Canada in order to take advantage of that. So I think that company has shown enormous growth, and with some of the disruptions in China into that sector, I think the more legitimate Western world Bitcoin miners, I think, will get superior valuations, and I think that company will probably publicly list in the next 12 months. So we're looking forward to hopefully a very strong outcome from that investment in Thorney Technology. So again, we like the growing awareness of cryptos. I don't want to say one crypto is going to be better than the other, but we do think that the space will become more popular, more utility in terms of transactions, and so we want to be in the infrastructure around it.
You tend to take fairly large positions in relatively small companies. Do you ever worry about your ability to exit these positions if they start to perform poorly? And what's your kind of approach for dealing with those situations?
Yeah, that's a good question, and something that I've dealt with right from the earlier investment scenarios that we had, that I was talking about right at the beginning of Thorney with those micro caps, because I would often buy 5, 10, or even 15 or 20% of those companies, and there's there's not much liquidity in them. So you have to really work to achieve an outcome basically in two ways. The company grows and you support the growth, and it becomes more awareness, and a broader shareholding base emerges, and you can sell into that progressively. Or in our experience, and fortunately for us, there's a lot of M&A transactions that emerge, and if you've got a substantial stake, you can be a key component in the success or failure of an M&A transaction. And so we've often leveraged our position to ensure an outcome in that regard. And actually, we're right now in an M&A cycle that's entering sort of turbo speed, and we've seen that at the top end recently with bids for Sydney Airport and Afterpay, and we've seen it at the smaller end with companies like Huon just recently, last week having a bid, and Empire, an IT services company, having a bid, both of them from overseas corporations. So I think we're entering a cycle of M&A transactions. So I'm hopeful that companies, not only in the tech portfolio, but in the top portfolio in particular, might be targeted. Now, is that the best outcome? And is companies, we don't want to sell too cheaply, obviously, and give up value. We don't want to sell at all if we can see a path for many, many years of growth. But obviously, it's a nice thing to happen in a way, because it validates your investment decision ultimately, and you have optionality about liquidity event if you want that, and that performance. So why is the M&A cycle so robust at the moment and likely to continue? I think for two reasons. One is money is cheap. Interest rates are still low, despite the conversation about inflation and whether rates will go up. And I do personally believe there is inflation in the system, and I do believe rates will go up at some point in the not too distant future. But at the same time, you've got massive government support going on and huge stimulus through infrastructure and other areas that perhaps will just defer that for a little bit. But the result of that is that there is the ability to borrow at relatively or historical kind of low costs. Share prices are high, so those with many companies have got value in their script that they can go and use also for consideration. And there's plenty of money on the sideline for investment. Private equity firms, out of the US, you've got all these SPACs that have got hundreds of billions of dollars actually to invest, and they've got a limited time duration in which to do that. And actually retail has got a lot of money also to invest. So the money is awash in the system at the moment, and that's finding a home in the stock market. And those companies that don't perform from a share price point of view for one reason or another, albeit it might be a short-termism reason, which is a direct impact through COVID and the lockdowns, which for example in the top portfolio of a company AMA, which is in automotive smash repairs, well, obviously if cars are not on the road, they're not having the same number of incidents, and so their numbers are down, and perhaps they're seen as vulnerable, for example. So I think the M&A cycle is one way out of those concentrated positions. And the other, of course, way is you have to work hard, and if you've got a big position, you can usually get access to the board or to management to have hopefully constructive dialogue. And if you can get your point of view across, or other shareholders' point of view, and we've got a pretty good track record in business decision making, we hope we can get those debates going, and that will hopefully help the company perform better, and even indeed making some hard decisions, such as closing off a division that's losing money and the capital is better off deployed elsewhere and management time is better off elsewhere. Those hard decisions that maybe support of large shareholders would encourage the boards and management to get on and do that sooner than later. So there's two or three different ways that we address it, but we are fully aware of the risk of concentration.
Let's get into talking some specific stocks. One of the companies in your portfolio is Oventus. which produces a sleep apnea product, which puts it in competition with one of Australia's most successful companies, ResMed. Could you tell us about kind of the similarities or the differences between those two products, and what attracts you to the Oventus product?
Well, I think Oventus is a really interesting story, because the ResMed has been, as you said, a huge success. And what we've learned through ResMed is how big a problem sleep apnea is, and other sleep disorders, including snoring and so on. So as people are talking more about their health issues in today's world, it's coming out as even a bigger problem. And the numbers are just huge in terms of people's discomfort, and also the effect on GDP in terms of people's ineffectiveness at work when they don't sleep or haven't had a proper sleep. There's a lot of time off and a lot of underperformance. So it's a huge problem, and it's a growing problem as people are becoming more aware. Now, ResMed has captured that market and done brilliantly, but with a machine that is very loud. When you put the CPAP over your thing, it's like wearing a mask. It's almost like you're an astronaut, you know, having the confines there. It's very uncomfortable. It's hard to lug around. It's a big unit if you're traveling. And the thing about Oventus, which is an Australian-based patented technology, it's almost the newest type of technology in an industry that's been doing the same thing for some 20-odd years. So as we've spent more and more time on the technology side, we're always looking for something that is a disruptor, something that can make a difference and address still a big market problem. So Oventus is such a company, but being a very small company fighting against a giant and getting market share is a difficult process. So it requires capital, it requires patience, it requires education, it requires scientific confirmation of the effectiveness of this oral device that they've got, and that takes a bit of time, and it's been a bit disappointing, and certainly COVID hasn't helped with a lot of the dentists and sleep clinics being actually closed. So they've had to adapt, and they're now teaching people how to get the fit out kind of remotely with a kit that can be sent to you, and training over a laptop or some other mobile device. But we believe that the contrast is so significant relative to the cumbersome CPAP that it will capture some of the market, and the market is so big that this company can be very valuable. So you've also, Pat, got to put it into perspective. This company is only valued at something like 20 or 25 million Australian dollars. So what sort of sales and penetration would it take for this company to be a lot more valuable? We think, even though it's taken a bit more time than we would have liked, we think the risk reward from a company like this is terrific. So, and it's going to do fantastically well for people's health and lifestyle enjoyment. So I love those companies that can potentially have a great financial return and you're actually helping people's well-being. I think that's like the golden ticket if you can do that. And if we can be a small part of that and help them on that journey, then I think the team at Thorney will be very proud of that outcome. But it's not there yet, but I think it's a company to watch.
More on the turnaround side of things, ServiceStream was a company that was, I'd say, somewhat of a market darling up until about 2 years ago or so. To start with, could you maybe explain what some of the challenges that ServiceStream has faced over the last couple of years have been? And what are some of the changes that you have advocated for or are advocating for in order to turn it around there?
Well, if you go back a little bit further than a couple of years, we've been involved in ServiceStream for quite a long time. It was connected to Skilled Engineering originally, which was a listed company. And it was a service for utility in the telco industry. It was actually laying a lot of the cable and doing the trenches and and all of that. So it was another, if you like, another asset or division within Skilled that wasn't getting enough attention for what it was. So it eventually went on its own journey and became a separate public company, but struggled in doing that after some good momentum, because it went out of its bandwidth and it entered a JV, which cost them a lot of money, and it was of a scale that they couldn't manage well. So that in itself led to a kind of change for them to get back on the right track. They introduced new management. A gentleman who was on the board at the time stepped into the role. He'd actually sold his business to them. He came in and became a much more active director. He recruited a new CEO who's the current CEO, and they went about turning around that business, exiting the bad contract, taking that on the chin, recapitalized, streamlined the business, went back to their basics. And then they've been a huge beneficiary over the last few years of obviously the NBN rollout and some of the things that's happening in the telco space. People didn't realize that they started expanding also into utilities, smart meters, reading your gas and electricity and those type of things, which was a good diversification. But I think with the spend on NBN being so huge, everyone's focus was on that, and there was kind of a view that because that was a perception that was being badly managed, that would be rivers of gold forever. And I think it even though they were running the company well, it would then got to be too expensive because the multiples that the market gave it were too high. I think on the basis that would sort of go on forever, and they would get achieving good margins while doing that. So I think it went on too high, and in fact we sold out a lot of our position when the stock not that long ago was about got up to $3 or through $3 a share, and we just felt, even though fantastic management, even though good contracts and all solid, valuation had got ahead of itself, and so we were quite disciplined in selling quite a lot of stock. Now I think it's come the other way around, as people have said, okay, NBN is finished and the margins are not there as much. It's gone right down. But NBN hasn't finished because there's so much maintenance to still keep going. And they've diversified, as I said previously, in utilities, and then more recently through this acquisition of Lend-Lease Services. And that gives them diversity, gives them scale, it gives them plenty of synergies. And if you believe in the management team, which we do, we think they've got one of the best management teams that are out there, certainly for a company of this size, and a very strong, capable board, of which many of the board members have equity in the business and actually put more equity in this recent capital raising. I think they will capture those synergies and run that business well, and I believe that actually the market is valuing it too low now relative to the potential that this new business gives to them. So we actually participated in the capital raising, and we look forward to them producing the results and the market understanding them better, that telco is only one part of their business, and this is a further diversification for them to balance the business and smooth out the earnings much better going forward, and that the management team is capable of delivering a very good outcome. So I definitely think this is a stock to watch over the next 6, 12, 18 months.
The last 12 months has been a rather challenging period for just about everybody. I'm sure everyone listening to this now would have experienced some challenges that they never expected to face before. What have you learnt about yourself in the last 12 months?
Well, I think everyone has been super reflective during this period. So I think I probably have as well. I think the first thing you learn is that your health and your well-being, your family are the most important things. Concentrate on them. Business is exciting, dynamic, but not the main game. But within business, obviously, there's been so many learnings as well. So we see how the world is connected, first of all, from the spread of the pandemic, but also from the use of technology like Zoom, that you can connect everyone and you can still relate and you can still converse and you can still conduct business in one form or another. So I think the innovation of human beings, the ability to adapt, is what we're seeing, and I think it's a pretty powerful message. So whilst there's certainly challenges, and we touched upon mental health earlier on, and we're seeing that as well as those directly who have had COVID, but we're seeing the mental health impact on people is huge, and obviously we've got to do a lot more in supporting each other and helping each other through the crisis time, but we shouldn't forget about it when the crisis is over. And we've got to do more work on using technology to connect to people, to help people, for people's well-being and their families and their carers and that whole ecosystem around that. So I think we have to learn to be more compassionate. We have to be more understanding of individuals, workplace environment, businesses who have genuinely out of their control been affected by what the world's thrown at them. I think you have to learn about that, and I think that is relevant, and I think it will make the world a better place if we can do that and take the learnings from this period forward. For myself, personally, I think it's connecting with the people around you, your friends and family. It's keeping yourself safe and healthy. It's identifying what it is that excites you, what it is that you want to do in your life. I'm fortunate enough that at this stage in my life I'm probably got enough years of experience and enough financial wherewithal to pursue what does interest me. And it does still interest me to do business. And as I said, all this ability to hopefully create some value with investors who have supported us by supporting technology and innovation and change that can help our planet and businesses function better is very stimulating to me. I mean, I think it's never been a better time, I've been saying lately, to be an entrepreneur, because the number of ideas that are out there and the deal flow that we can see, young entrepreneurs have identified opportunities, they're fearless and they're global in their thinking. It's really an exciting time. So there's no way I'm stepping away from business and being involved at this time. I like it. I think it's fascinating. And if we can take our experience and our wisdom and help some of these young entrepreneurs achieve their dreams, that'll be rewarding for us, certainly. So I'm excited by that. More and more philanthropy from my point of view. I get to follow Collingwood as a fan rather than having to go to board meetings, which is another way of doing it, and I'm excited about that and going forward. So I just think that, you know, as I said, we've all had to reflect and we find a way that, and we should not forget our learnings from this year. Not that the world is going to normalize anytime soon, but let's all remember to the important things in life.
Well, Alex, thanks for taking the time to chat to me today. I know it's a bit of a logistical challenge during lockdowns, but I appreciate you taking the time out of your day, and thanks for sharing your views.